Decker's Outdoor is down 50% this year. It's down almost 53%, 54 actually, from all-time high from back in January. I am going to buy it. And in this video, we're gonna go through some numbers and see what's going on. Before we buy anything, we always want to take a look at the graph, at the price action, just to see what's been going on. So it's been crashing pretty hard, but keep in mind this stock is up 183% over the past 5 years. So yeah, swings are going to be brutal. It happened before. 4 years ago, 2021, the stock was around 72, dropped by more than 40%, down to 41. It got tested and retested at around this level, as you can see, 40.9, and then 41, and then 40.7 again. Then started growing. Let's see here. What do we have here? So dropped from 223 down to a bottom of 100 a few months back in April. Got a bit of a relief rally, crashed again, pretty big, 18% in 1 day or so. And then, yeah, it seems like it likes this kind of price. It bounces back from this price. Dipped below 100 last month, but it did not stay there very long. So I like this kind of price action. It shows me that it's trying to stabilize at this price. There are buyers at this price point, and it seems like, yeah, it's just going sideways. There are not a lot of sellers either. So let's just go into the numbers here. $15 billion company, forward PE 16, and right now trailing PE is at 15.5. So increasing a little bit in PE. What does that mean? That means future earnings are going to be just a little bit lower than they are right now. Let's take a look at revenue graph. 10 years ago, they were doing 1.9 billion. Today, they are doing 5 billion. Keep in mind, this type of graph we have seen before in a lot of companies that were kind of flatlining before 2020. They got a bump after 2020, and now they're kind of cooling off. But with this company, the growth is continuing. It's just 15%, 15. 2024, 18%. This year was 16 in March when they reported their quarterly earnings, and trailing 12 months is around 15 as well. So yeah, it's still growing pretty nicely here. We don't see any signs of cooling down, which is great when we are dealing with a company that shaved off more than 50% in its price. This is great for us to see. Shares outstanding. Let's see what type of company this is. This is looks like a very mature company that buys back shares consistently. The share count, the shares outstanding graph here is just showing us that it's just going down over time pretty consistently here. Let's take a look by percentages. 10 years ago, they managed to do 5%, another 6.5% 2019, 4% to 2020. They're doing about 2% now. And I think since the price dropped by more than 50%, a company that is doing consistent buybacks like this, it also slows down when the price is high. I think this might tell us that there is some kind of solid floor to the share price, and that management will intervene by buying back shares when they think the stock is undervalued. And they're doing it consistently anyway. We're going to take a look at cash flow to see how much money they're pouring into buybacks. And yeah, look at this. So in terms of dollars amount, today they're doing a lot more than they were in 2016 because they were a much smaller company back then, but in terms of percentages, it's smaller today. But yeah, they've just been growing and growing and buying back shares by the dollar amount because they are growing in profitability and they just return that free cash flow to shareholders. Let's take a look at margins just to compare it a little bit with the S&P 500 and just to see where it's trending. So 10 years ago, 45%, it was basically in line with the S&P 500. Today, it's a lot higher at 57%, and you can clearly see the trend up. So this company has been improving over time, which is exactly what you want to see. You want to buy into growing companies, not stagnating, very mature companies that don't have a lot of headroom for growth. They just but they have a lot of room for falling down. and revenue margins, and also plummeting in share price, like we analyzed yesterday with Nike. So yeah, operating margins as well, growing very nicely, more than doubling in the last 10 years, from going from 10% to 23%, 24, and 24% is a lot higher than the 15% that S&P 500 has as an average. So this is great to see. We are buying a simply a better company than the S&P 500 average. So whenever you're going outside investing in individual stocks, there's always a risk of underperforming the S&P. So you want to take a lot of margins of safety, and by picking high quality companies like this one is Decker's Outdoor, having better margins, better profitability than the S&P 500 average. If you have a basket of these kind of companies in your portfolio, you are offering yourself a solid chance not to lose money, not to underperform. And it's just yeah, it matters from there. It matters when you buy it, when you sell them. You're not gonna just buy this and hold forever. That's just stupid. Whenever people say that, oh, I'm just investing for the long term, I buy and hold. Anything outside the S&P 500, if you buy and hold it, it's just guaranteed to mature at some point and start to stagnate, not offer any growth, and start to crash in price. So yeah, buying and holding is not a viable strategy. I have not seen anyone buying and holding and be successful consistently. Not even Warren Buffett. He has like 3 stocks that has been buying and holding: American Express, Coca-Cola, and I think one more, and that's about it. The rest of them, he's just been buying them and selling them after when he's made a lot of profit on them. But yeah, let's just move on. Let's take a look at the balance sheet, cash and cash equivalents. 2016, they had a positive of 245 million in the bank, but keep in mind what the market cap was 10 years ago. It was 1.9 billion. So even back then, as a percentage of the market cap, it was pretty big. So today they have been growing and growing their cash pile, as you can see here, which is a great sign of the company growing, improving margins, improving all of the metrics, and growing their cash piles, which is great. And they have been improving this cash pile while also increasing share buybacks. As you saw before, they were doing more and more and more in buybacks, and they were able to save some cash and improving their cash piles, which is also great. I mean, this is exactly what you want to see. These are all good. These are all signs of a good company, of a great company. They're improving every single metric. Let's just see. For now, all that I've seen is good, great growth, and also future potential. Nothing deteriorating. Let's see, net cash debt. They were never negative in the net cash. They were always positive here. 145 million 10 years ago, 1.4 excess cash today. Let's see, let's take a look at the total debt over time. 10 years ago, 100 million. Trailing 12 months, 300 million. This is nothing. I mean, you can consider this company almost never to go. It's impossible. Not in the next 7 to 8 years. It's just not possible. This company is a tank. I mean, it's very, very solid. I like what I see here. Let's take a look at cash flows. We want to take a look at the net income and stock-based compensation. So we just have a graph going 5 years back. I don't know why. It's kind of weird. So the other graphs, now it's showing, yeah, I don't know why it just showed me the last 10 years. Now it's showing, oh, okay, we're back. Small glitch there, I guess, with this website. 10 years ago, they were doing 122 million in net income, and stock-based compensation was about 6 million. Now they're 38 million out of a net income of almost $1 billion. So yeah, stock-based compensation compared to net income, compared to the top line of 5 billion, this is nothing. This is pocket change. This is exactly what we want to see. We don't want to get diluted. We don't want our share or pie of the company getting vanished, getting obliterated by stock-based compensation and other type of dilution. So yeah, issuance of common stock, yeah, 4 million. They never had really high issuance of stock. They were always pouring money, a lot more money in repurchases. This is great. This is what we want to see. Let's just take a look at free cash flow. Growing nicely over time and trailing 12 months, $900 million. That's great to see. Keep in mind, this company is $15 billion in market cap right now, and it's still growing double digit. I mean, mid-teen double digit growth to it. It's kind of crazy. So the market cap has shaved more than 50% of its total from 2024. I think it's a great entry point right now. Let's take a look at PE. We cannot read this. But 2022, when it also crashed, it went to a low of 16, 15. Now we're at 15 again. So again, another sign of a good entry point. 10 years ago, it was hovering around 9 forward PE. Nowadays, it's at 16. But it was a different kind of environment for this company. 2022, when it bottomed, it had a forward PE of 14. So again, I think this is a great entry point into this company. Price to sales of 3. For a high margin, high growth company, this is very good. EV to EBITDA, it was trading at around 24 times last year. Now it's at 10. Perfect. I like to see this. I mean, whenever you're trying to think about valuations, always take into account the market cap that it has, the potential that it has ahead compared to its competitors. How much market share can it grab from the big players while it's growing? So when you take a look at EV to EBITDA of 10 times, and you think about, okay, this company is still growing double digits, this is just not going to stay here for long. I mean, it's just not. And it's already past 6 months since it dropped. 6 months ago. Actually, a bit more. Oh, January. Yeah, so we're at 8 months into the downswing. Yeah, the bottom, I just don't see it lasting a lot longer, because in all this time, the company is improving metrics and it's buying back shares. It's just going to improve earnings per share. It's going to become more profitable. Let's take a look biannual at return on invested capital. Yeah, look at this, trending up very nicely, and it's sitting at around 30% trailing 12 months. This is great to see. I love this. Yeah, I mean, it's just a lot higher than the S&P. And this shows, simply put, how efficient the management is with the invested capital. What type of returns do they get for the money? Return on capital employed. This is the same kind of metric, but it's a little bit broader. It's not so precise. So 43%, also trending up, as you can see here on the graph. You just want to take a look in which direction the company has been going for the past 10 years and think about, where is it probable that it's going to go from here? Is it probable that it's going to continue to grow? Yes, that has a higher probability. Is it probable that it's going to flatline? That also has a solid chance of happening. Is it probable that it's just going to crash in return on capital employed and ROIC after trending up for so long? I would say not so probable. So when you have your share price plummeting, this is a great opportunity. You have to take all other things into account and make a bet. Put your money where you think is going to produce a higher return than the S&P 500. So FCF yield, another valuation metric. The S&P 500 is sitting at around 2.8%. This is more than double the S&P. So we're getting at twice. So we're getting a lot higher quality company for twice as cheap. So this is a great opportunity to make some money. Whenever you see this discrepancy, there's a chance to outperform the S&P 500. So time to allocate some capital. I guess I'm going to be buying this today. And yeah, I'm going to talk next about Crocs. Crocs is another company that I've been dabbling in and on and off for the past few years. And this also has been crashing pretty hard. I might open a small position in this one as well. I'm going to be making a video soon and releasing it on the channel.